Good afternoon, everyone. I'm Inki Cho, Senior Financial Market Strategist at Exness, and this is your weekly market outlook for February 25th, 2025. The US stock market rally appears to have lost its steam as enthusiasm for AI investments shows signs of stagnation. Several headwinds, including the Trump administration's tariff policies, weakening U.S. economic data, and concerns over elevated equity valuations, are discouraging the buyers. According to the Bank of America Fund Manager Survey, approximately 90% of respondents believe that U.S. equities are overvalued, marking the highest level of valuation concern since April 2001, nearly 24 years ago. This highlights how stretched valuation have become, particularly in large cap tech stocks that have driven much of the recent rally. Although the Magnificent Seven stocks remain dominant in attracting capital inflows, a notable shift is occurring. Investors are increasingly looking toward European and Chinese equities, as well as alternative assets like gold, as they seek opportunities outside of an overheated U.S. stock market. Market sentiment was further shaken by a TD Cowen's report, which raised concerns about potential overinvestment in AI infrastructure. The firm highlighted that Microsoft has begun canceling or scaling back significant data center leases and construction projects across the US. This move suggests that the company may have overbuilt its AI computing infrastructure relative to actual demand, reinforcing fears that the AI boom might not translate into immediate financial gains as expected. Investors have been pricing in long term AI growth, but if actual adoption and monetization lag behind these expectations, significant market disappointment could follow. The fact that one of AI's biggest beneficiaries, Microsoft, is scaling back infrastructure investment raises broader concerns about the sustainability of AI driven stock market gains. If AI related revenue growth does not materialize as expected, it could trigger a significant valuation reset in tech stocks, which currently trade at historically high multiples. One of the key reasons behind the recent stock market stagnation is the deterioration in the US economic data, which suggests that economic momentum is slowing down. The US January services PMI fell sharply from 52.9 to 49.7, missing the market consensus of 53, and more importantly, slipping below the neutral 50 level for the first time in 25 months since January 2023. This signals contraction in the service sector, which is significant given that services account for approximately 70% of US GDP. A prolonged contraction in the service sector would likely lead to slower consuming spending, weaker job growth, and potential downward revisions to GDP forecasts. Investors will closely monitor upcoming service sector data to gauge whether this is a temporary setback or the beginning of a more sustained downturn. Adding to concerns, the University of Michigan's February Consumer Sentiment Index declined from 67.8 to 64.7, reflecting deteriorating consumer confidence. This decline suggests that households are increasingly worried about the rising costs, job security, and economic uncertainty, which could further weigh on spending and economic activity. An even more concerning development is the simultaneous slowdown in economic activity and persistent inflationary pressures, raising fears of a stagflation. 1 year inflation expectations remained unchanged at 4.3%, but 5 year inflation expectations climbed from 3.3% to 3.5%, marking the largest monthly increase since May 2021. This reflects growing concerns that inflation may remain elevated for longer than previously anticipated, particularly with the prospect of higher import prices due to new tariff policies. Meanwhile, the Dallas Fed's Texas Manufacturing Index fell sharply from 14.1 in January to negative 8.3 in February, underscoring a deteriorating manufacturing sector. The report also showed a significant 11-point drop in new orders, indicating that demand for goods is softening. At the same time, inflationary pressures within the supply chain are intensifying. The raw materials price index surged by 18 points, while the finished good price index rose to 7.8. And this suggests that input costs are rising even as demand weakens, a classic signal of stagflation. If these trends persist, the Fed may find itself in a policy dilemma where rate cuts to support the economy could fuel inflation, while keeping rates higher for longer could deepen the slowdown. Labor market conditions are also showing early signs of strain, particularly as the Trump administration takes a hardline stance on federal employment. Reports indicate that Doge, led by Elon Musk, is pushing for mass layoffs of federal contractors, with potential job cuts affecting up to 1 million workers. This could significantly impact unemployment claims in the coming weeks, raising concerns about the broader labor market. Additionally, corporate layoffs are accelerating, and according to Bloomberg, the number of announced layoffs surged to 15,651 last week, marking a 12-month high. And while the labor market remains relatively strong, a sustained increase in job cuts could lead to higher unemployment and weaker consumer spending, further weighing on economic growth. Despite mounting economic headwinds, Trump's aggressive tariff policies are moving forward, creating additional uncertainty for businesses and stock markets. Initially perceived as a negotiation tactic, these tariffs policies are now being actively implemented, and the administration has announced a 25 tariff on automobiles effective April 2025, and an additional 10% tariff on Chinese imports, a 25 tariff on steel and aluminum. Furthermore, Trump has threatened tariff on semiconductors and pharmaceuticals, signaling that more trade restrictions could be on the horizon. This tariff could exacerbate inflation by raising input costs, which in turn could force the Fed to maintain higher interest rates for longer. If rate cuts are delayed due to persistent inflationary pressures, it could negatively impact risk assets such as equities, while boosting demand for safe haven assets like gold and US Treasuries. While the US stock market faces multiple headwinds, Chinese equities are experiencing renewed investor confidence, driven by both valuation attractiveness and AI driven optimism. The CSI 300 index has surged 20% over the past 6 months, approaching to 4,000 level. And Goldman Sachs recently raised its target for the index from 4,600 to 4,700, forecasting a potential 17% upside from current levels. One of the major catalysts behind this rally is China's AI advancements, particularly in DeepSeek. And market participants believe that Chinese AI companies may soon rival Western counterparts, driving renewed interest in Chinese technology sectors. Chinese tech giants such as Alibaba, Tencent, and Xiaomi have posted strong gains in response to this development, leading the Hang Seng Index to rise by more than 30% over the past 6 months. Moreover, the US equity valuation at historically high levels, some global investors are reallocating capitals to Chinese stocks, which trade at significantly lower valuations. And if this trend continues, China could see continued capital inflows, further fueling its stock market rally. Carefully review the above data before proceeding with successful trading. This is the end of the market outlook for the 25th of February 2025. I'm Inki Cho, the Senior Financial Market Strategist at Exness.